All right, deep divers, buckle up. Because today,
Yeah.
we are diving into the world of stock valuation.
Right.
And specifically,
Right.
the PER,
Yeah.
or price-to-earnings ratio.
Okay.
You want to know if a company's stock is a good deal,
Mm-hmm.
or if you're about to buy into
Right.
an overpriced nightmare.
That's great. That's a smart question to be asking because the PER can give you a sneak peek
Okay.
into a company's financial health.
Okay.
It can even hint at its future potential.
Okay. So it's a peek behind the curtain,
Yeah,
but not the whole story.
exactly.
We're talking about using this PER thing to make investment decisions.
Right.
Break it down for me. What exactly is this ratio?
Well, imagine you're buying a bakery.
Okay.
You wouldn't just look at the price tag, right?
Right.
You'd want to know how much profit it makes each year.
Mm-hmm.
The PER is similar.
Okay.
It tells you how much you're paying
Okay.
for every dollar of company's earnings.
So if a company has a PER of 20, that means investors are willing to shell out $20
Yeah.
for every dollar of profit the company makes.
Exactly.
Why would they pay that much?
That's where it gets interesting.
Okay.
A high PER often means investors are betting on the company's future.
Okay.
They're thinking this company's earnings are going to skyrocket in a few years.
Mm-hmm.
So I'm willing to pay a premium now.
So it's like buying a promising startup.
Exactly.
The current earnings might be small,
Yeah.
but the potential is huge.
Mm-hmm.
And how do we actually calculate
Yeah.
this magical PER?
It's surprisingly straightforward.
Yeah.
You take the company's market capitalization,
Oh,
which
yeah.
is basically its total worth in the stock market or the price of all its shares combined,
Mhm.
and divide that by its net income, which is the profit it made.
Got it.
Yeah.
So market value divided by profit.
Exactly.
But let's say a company is publicly traded.
Mm-hmm.
Like, I can buy their stock on the open market.
Right.
Is there another way to calculate the PER?
You can also calculate it using the price per share and the earnings per share.
Okay.
Just divide the price per share by the earnings per share, and you'll arrive at the same PER.
Okay, so two ways to get to the same number.
Right.
But like with anything in the stock market,
Yeah.
I'm guessing there are some caveats to keep in mind.
You're right to be cautious.
Okay.
One thing to remember is that the PER shouldn't be used in isolation.
Okay.
It's not a one-size-fits-all metric.
What do you mean?
Yeah.
Are there certain industries where the PER might not be as reliable?
Exactly.
Oh, sorry.
For companies with unpredictable earnings, like those in the oil or gas industry,
Okay.
the PER might not tell you the whole story.
Right.
Their profits can swing wildly depending on global events and commodity prices.
So using the PER to evaluate those companies
Yeah.
might give a misleading impression
Right.
of their actual worth.
Exactly.
It's not a crystal ball,
No.
just a piece of the puzzle.
It's one data point among many. Another thing to remember is that the PER relies on a company's reported earnings,
Okay.
which can sometimes be, shall we say, massaged.
You mean companies trying to make their earnings look better than they actually are?
Unfortunately, it happens.
Playing accounting games.
Exactly.
Not cool.
It's important to be aware of that.
So we've covered what the PER is
Mm-hmm.
and how to calculate it.
Right.
But the million-dollar question is,
Yes.
how do we actually use this to make investment decisions?
Right.
What makes a good PER versus a bad one?
Yeah. Now we're getting to the heart of it.
Okay.
There's no magic number, unfortunately.
Uh,
But think of it like this.
Oh.
A lower PER could be a sign that a company is undervalued.
Okay.
Like maybe investors haven't caught on to its potential yet,
Mm-hmm.
and that could be a buying opportunity for you.
Okay, so low PER, potential bargain.
Right.
But what about those companies with really high PERs?
Yeah.
Are those automatic avoid?
Not necessarily.
Okay.
A high PER could mean investors are really excited about the company's future growth.
Mm-hmm.
Think of those tech darlings everyone's buzzing about,
Right.
even if they're not turning a huge profit yet.
It's like that saying, buy the rumor, sell the news. You're right.
Exactly.
But how do we know if a high PER is justified
Yeah.
or if investors are getting caught up in the hype?
That's where your critical thinking skills come in.
Okay.
You need to look at the company's track record, its industry, and its competitive landscape.
Mm-hmm.
Is it truly disrupting the market, or is it just a flash in the pan?
So a high PER for a company like, say, Tesla might make sense,
Right.
given its innovation and growth in the electric vehicle market.
Yeah.
While a similar PER for a struggling retailer might raise some red flags.
Exactly. Context is everything.
Okay.
You want to compare a company's PER to its own history. to its competitors, and to the overall market.
Okay.
It's about spotting those relative differences and understanding what's driving them.
It's like detective work.
Yeah.
You're piecing together clues to see if the PER is telling you a believable story.
Right.
So we've talked about high and low PERs.
Right.
But is there a Goldilocks zone?
Yeah.
A PE range that's generally considered a good sign?
Unfortunately, there's no magic formula.
Okay.
But a helpful exercise is to look at the historical PERs of companies you admire, those that have consistently delivered value over time.
Okay.
See where they've typically traded. And if their current PER is significantly higher or lower, that can give you a starting point.
That's a great tip.
Yeah.
Look at the companies you already trust.
Right.
And use their PERs as benchmarks.
Exactly.
And you mentioned earlier that the traditional PER has some limitations.
Right.
Specifically, that it only looks at 1 year's worth of earnings.
Yeah.
What if we want a more long-term perspective?
You're thinking like a seasoned investor.
Well,
that's where the PER Shiller or Case E ratio comes in.
Okay, tell me more about this PER Shiller.
Yeah.
Does it involve a crystal ball?
Not quite a crystal ball. Okay.
But it does give you a glimpse into the past.
Okay.
Instead of using just the most recent year's earnings, the PER Shiller takes the average inflation-adjusted earnings of the past 10 years.
So it's like taking a longer view.
Exactly.
Smoothing out those short-term blips and dips in the market.
Exactly. This approach helps to reduce the impact of economic cycles or one-off events that might skew the traditional PER.
That sounds particularly useful in today's volatile market.
Absolutely.
Yeah.
If you're investing for the long haul,
Okay.
the Shiller PER can be a valuable tool because it gives you a more stable, a realistic picture of a company's earning power over time.
So if the traditional PER is like a snapshot,
Yes.
the Shiller PER is like a time-lapse video.
That's a great way to put it.
Okay.
And by comparing the two,
Yeah.
you can get a more comprehensive understanding of a company's true worth and whether its current valuation is justified.
So if I'm understanding this right,
Yeah.
the Shiller PER could be particularly useful.
For spotting those market bubbles everyone's always worried about.
Exactly.
Like if a company's traditional PER is through the roof,
Yeah.
but its Shiller PER is more down to earth,
Right.
that's a sign to maybe proceed with caution.
You got it. That kind of discrepancy could be a warning sign
Okay.
that the current market frenzy might be overblown
Okay.
and the company's long-term earning history doesn't quite support the hype.
It's like that restaurant everyone's raving about,
Yeah.
but they've only been open a month.
Right.
You have to wonder if they can keep up that level of quality over time.
Exactly. Always good to see if the long-term track record
Yep.
matches that short-term excitement.
This has been incredibly eye-opening.
Good.
So to wrap things up,
Yeah.
what are the biggest takeaways our listeners should keep in mind
Sure.
when it comes to using the PER,
Yeah.
both the traditional and the Shiller version,
Right.
to make smart investment choices?
I think the most important thing to remember is that the PER is a tool,
Okay.
not a crystal ball. It's one data point among many, and it's most effective when it's used in context,
Okay.
along with other research and analysis.
Right. We wouldn't buy a house based solely on its square footage,
Right.
location condition.
Exactly.
All those other factors matter too.
Precisely. When you're evaluating a company, you need to look beyond just the PER
Okay.
and consider things like its management team, its competitive landscape, its debt levels,
Right.
the whole picture.
So it's about being a financial detective.
Yes.
Using the PER to uncover potential opportunities,
Right.
but then digging deeper to see if the numbers really add up.
Absolutely. The PER can be a great starting point for your research,
Okay.
helping you narrow down your options and identify companies that might be worth a closer look.
Okay.
But it's just the first step on your investing journey.
Fantastic advice. Well, deep divers, I hope you're feeling as empowered as I am after this deep dive into the world of the PER and the PER Shiller.
Yeah.
Who knew a simple ratio could be so insightful?
It's amazing, right?
Keep those questions coming, deep divers.
Yeah.
And we'll be back soon with another deep dive into the world of finance.
Looking forward to it.
Until next time.